Hello and welcome to this Markets Today special. My guest on the show today is Mahesh Nandurkar, longtime observer of the Indian market and managing director and head of research at Jefferies. Mahesh, good to see you after a long time. I was just having a conversation with a very old timer fund manager, mutual fund manager, and he said that the macro story for India is great, but valuations are still not compelling and not challenging and quite challenging. Would you agree with that, or would you say that it's a good entry point for India now?
Yeah, thank you, Dan. Thanks for having me here. Yeah, actually are absolutely right. I would kind of, echo the sentiments. I do believe that the macro story is looking very compelling for sure. Quite confident about 15% plus earnings growth, which is like one of the highest that we've seen, that we will be seeing in any of the major markets globally. So yeah, all that is looking, quite well. But yeah, but valuations is definitely sticking out. When the markets corrected earlier in February or so, when the Nifty was at around 17,000, it was looking pretty interesting, but the markets have moved up pretty quickly, up about 10% or so from there. And yes, many stocks and sectors are looking yeah, expensive at this point in time. Yeah.
Hmm. There is a fear in certain quarters in the market that during the course of this year, we'll get another spike in volatility. And you may even get the market back to the kind of levels which you found interesting. Do you expect something like that? I know it cannot be predicted, events cannot be predicted, but is it a likelihood in your eyes?
I think the event that will probably create volatility in the Indian markets will probably have to be a global event or an international event. I do not foresee too many negative or let's say big negative events for the Indian markets, which will be domestically sort of caused. My sense is that you'll probably see, or you could probably see some volatility created by either some unexpected change, say in the Fed policy, or some other kind of dislocation that might happen in the capital markets globally or something like that. But as far as the developments domestically go, uh, to me it looks unlikely.
Hmm. How would you position a portfolio right now for people, domestic investors are by and less, by and uh, has invested in the market right now. They've not pulled out any money. But at this point, would it make sense to stay with mid caps and small caps, which have started performing again, or would it be better to be with large caps at a time when valuations are not very low?
Yeah, a very fair and pertinent question. So then, in fact, we did publish a research note on the same topic. What I believe is that, so as you rightly said at the outset, the broader market valuations are looking a bit on the higher side, and that is what is, making the investors a bit uncomfortable. Um, but I believe that the mid caps and the small cap space definitely offers a more upside and the more risk reward. And the reason is not so much the choice of the market capitalization itself, but it's more to do with what the mid cap and small cap actually represent. The mid cap and small cap actually represent the India story. And what I mean by that is if you just look at the Nifty 50, the large cap index, then you will see that the proportion of outward looking sectors like the IT, pharma, steel, oil and gas, other sort of commodities accounts for roughly 35 to 40% of market cap. And 60%, 65% is the domestic oriented stocks. Whereas the same proportion for mid cap and small cap index is roughly about 80% plus. And I, for one, definitely believe that given where the global environment is, it makes sense to be more overweight and more optimistic position on the domestic oriented sectors and stocks rather than outward looking sectors. And from that context, I believe mid cap and small caps offer better upside and better risk reward. Also, I wanted to highlight one more point as well, which is that our favorite sectors has been real estate and industrial, or let's say the capex cycle plays. And once again, those sectors are very thinly represented in large cap indices. Once again, that number is like about 5% of the Nifty market cap is in those sectors, whereas if you look at mid cap, small cap, that proportion is higher than 20%. So yeah, so those are the reasons, then I would say that the mid caps and small cap look more interesting at this point in time.
Mm. It's an interesting point that you make because I can't remember when L&T was actually a big performer in the index. I mean, it's gone through probably a decade and a half. I mean, since the 2007, 2008 bust up, that it's not had any role of even some kind of semblance of leadership for the market. Do you think the time is coming where some of these kind of heavyweight stocks, which traditionally would make up a core part of a person's portfolio, maybe 15 years ago, they could start leading the market again?
Yeah, I definitely think so, that there is a greater acceptance of the investment cycle, upcycle, which is showing signs of unfolding in India and which could be a multi-year story. But the key problem that we face when we speak to large investors is that there aren't any large and liquid stocks to play that story on. And some of the large cap names also have issues with with the ESG related issues as well. Hopefully those get sorted out. But as things stand today, yes, some of those large cap names do have some ESG issues, and that's why the focus is going towards more mid cap, small cap names. But yeah, but I completely agree with you that investment cycle plays and capex related plays is I guess the way to go, because those stocks will likely deliver a much better outperformance.
What's the right way to play this? Because some people choose to play it through the companies which are delivering the capex and working on it. Others choose to play safe and play the lenders. What's your what's the right approach to this capex upcycle, if there is indeed going to be one?
I would say that the best way to play is, I mean, there are multiple choices that you have, as you rightly said. But I believe the best and the most sort of the best risk reward, I would say, would be the direct way to play that. So I would actually also include real estate developers as well into that list, because many a time when we talk about capex cycle, we actually leave out the largest portion of the capex activities in the country, which is actually the real estate development. So I would actually include that as one of the most direct ways of playing. But yes, but there are other ways of playing as well: contractors, the capital goods companies, the automation companies, and essentially the companies that are going into kind of delivering either the services or the goods that go into so building of infrastructure, building of housing units, and building of new capacities. So that would include names like cement, etc. as well, apart from the capital goods and the contractors and the real estate developers. But yes, if you are looking at some of the large names and more liquid names, then some of the lenders as well make a lot of sense. I would particularly draw attention to some of the banks that have been laggard recently. Those include some of the PSU names as well. So yeah, so lenders is definitely one large and liquid way to play that.
Hmm. What's going on with the HDFC family, Mahesh? I mean, it's always been those blue chips which nobody ever sells from the portfolio. Yet, you ask investors over the last few years, there seems to be an air of disenchantment. Do you think they'll rediscover their magic?
Well, then I will not be able to comment on individual stocks here. But yeah, but one thing that I can say is that among the the traditional large cap sort of banking sector companies, uh, many of these names are also very well owned, both by the international investors as well as the domestic investors as well. So I think we'll also have to take into account the ownership factors here as well. Also, over the last, I would say over the last few months, many of the investors have been talking about change of leadership at various large cap companies in India. That include some of the banks, some of the consumer companies, and also some of the industrial names as well. And some of these leaders have been at the helm for the last 5 years, 10 years, and some even 20 plus years as well. So there has been that level of comfort that has got developed, over a period of time between the investors and and the stocks of the companies. And with so in fact, we were doing this analysis, and more than 25% of the large caps by market cap are actually undergoing, are going through a period of leadership change at the top. So some of those factors are also going to be impacting these names.
Right. What about consumer companies? They've had really their time in the sun over the last 10, 15 years. But over the last 2 years, there's clear signs that they're tiring out, that some other sets of stocks are coming to the fore. And we've known, looking back in history, that when consumer companies go through, expensive consumer stocks go through these periods, they can sometimes underperform for 7, 8, 10 years. Is that your expectation this time around?
Well, I think this is going to be one very, very long term and a very, very interesting trend that you've just touched upon. And if look at the broader economic data, uh, then and if you look at the PFCE, the private final consumption expenditure as a share of GDP, that went through a period of a massive upswing from 2008 until 2020. And it went up from almost low 50s to 60% plus as a share of GDP. And over the same time, the gross fixed capital formation, or in loose terms, investments as a share of GDP, fell by almost equal percentage points until 2020. But in that long-term economic trend, now we are seeing some signs of reversal. The consumption expenditure as a share of GDP has started to come off, and the investment expenditure as a share of GDP has started to go up. And I think this is a very, very, sort of a pertinent change of trend that we'll need to keep in mind. It's not just an economic change, it's actually a change that impacts the stock market valuations and the sector pickings as well. So, I'm a firm believer that India is in the midst of the capex upcycle. We are just in the beginning phase of it, which essentially means that investments as a share of GDP will continue to rise, consumption as a share of GDP will continue to fall. It doesn't necessarily mean that we're going to see degrowth in the consumption. It's just that it'll grow at a lower pace as compared with the nominal GDP growth rate. So yeah, so to answer your question, I do believe that the last 10 years was a period of huge re-rating for many of these consumption stocks that went up from 20 times to 30, 40, 50, 60, 70 P multiples. And in fact, so much so that I would argue that many investors have actually forgotten that some of these stocks did used to trade at 25, 30 times as well, say 10 years ago. I think we will probably be seeing a change in the trend in the market valuations, where many of these expensive consumer names, which will probably not be able to deliver the growth that that we've been used to seeing. And at the same time, one other set of stocks, which are mostly the capex and the investment oriented stocks, which have had various issues related to not just the CG but also the business environment itself being weak. That segment will probably look to sort of occupy more and more space in the investor mind, and those are the kind of stocks will go through a period of re-rating. So yeah, I think we will have to kind of go through this period of one sector probably undergoing some round of derating, which will be consumption related stocks, especially those who will not be able to deliver on the growth expectations, whereas the investment oriented stocks I think will keep on getting re-rated upwards.
At any point, would you be tempted to consider a contrarian position in any of the global facing sectors, which you are not very bullish on right now for obvious reasons? But they say valuations capture a lot of the bad news. At some point, and some of these are high quality companies, in terms of governance and management, at some point, would you consider wading into them, or do you think the time is not right for these companies and they will underperform for the foreseeable future?
No, at some point in time for sure, because there is nothing permanent in the stock markets. And as you rightly said, valuations do capture some of the some of the future risks as well. So at some point in time, those stocks will begin to look more attractive. So in the Indian context, we're essentially talking about IT, pharma, some of the commodity stocks, etc., which are probably the ways to play the global economic recovery. But at this point in time, I don't think we're looking at a global economic recovery, as such. Our house view is that from the September quarter onwards, we will be entering a period of recession in the US, which could last for anywhere between 3 to 5 quarters. And I therefore believe that now is too early to dip into some of these sectors. I mean, IT services sector arguably, is a sector that has underperformed, say, over the last 3, 4 months. But I would say that March quarter was the first quarter where some of the large cap companies actually disappointed. My sense is March will not be the last quarter. We will probably see some more disappointments coming up in the June quarter and possibly in September as well. So we'll probably look to kind of be more constructive in that space, say, I would say in a quarter's time from now.
We've seen some good inflows from FIIs over the last few months after a long time. Do you see this continuing, Mahesh, or could that mood change quickly with a global event once again?
Yeah, global events could change that for sure. But if you look at the investor positioning, the global investors positioning in India, I would say it's at the lightest level that I've ever come across in my career. And what I mean by that is, um, over the period of last 3 to 4 months or so, I would have met more than 100 plus international investors face to face. And I can very easily say that nearly half of those have been underweight on India. I've never ever come across any period of time historically where such a large number of international investors were underweight on India. And the key sort of issue with most of the investors has been valuation, as we discussed in the beginning. But my sense is that as the kind of market probably will sort of likely move sideways, and the valuations will continue to sort of become more attractive, because ultimately we are looking at close to 20% earnings growth this year, another 15% the year after. So if we go through a period of sideways market movement, the valuations will automatically keep on getting more attractive. And also the geopolitical situation globally is clearly favoring India in terms of the various options that a typical emerging market investor has. So yeah, so to answer your question, I believe that the flows should remain on the positive side, although not hugely positive because of the valuation constraints. But if for whatever reason market were to correct, I think the flows will improve.
Mahesh, always a pleasure hearing your thoughts. Thank you very much for your time today.
Thanks a lot, Udayan. Thank you for having me here.
Thank you. Bye.
If you like the video, do like, comment, share and subscribe.